Right, I think pretty much everybody's in there now. Right, so good morning, everyone. Thanks for joining us. My name's Rees. I'm the managing partner at Convergence Partners. Really pleased to welcome you all along. Thanks for taking time out. I don't know anyone that isn't having a pretty sort of full-on final few weeks as we run into Christmas. So really appreciate the time you're taking. We've got Jarrod Kerr with us today, and really looking forward to his thoughts on things. Just thought I'd provide a little bit of context for this before I introduce Jarrod. Convergence has got a pretty significant footprint in the manufacturing and FMCG sectors, and we've had that for quite some years now. It's upwards of around 50% of our business. So we help companies to find talent across supply chain and operations, sales and marketing, and also finance and accounting. And it tends to be leadership roles, but also a fair number of kind of specialist positions as well. Obviously, we're aware of a lot of the challenges that have been facing the sector through this year. We thought it was a good idea to try and find someone who could help shed some light on the problems, help to make sense of them, and provide some thoughts on the direction that things are likely to take. So with that said, we're delighted to have Jarrod with us. Format today will be presentation by Jarrod, and then I'll try and squeeze in around 5 minutes or so to give you a quick update on the talent landscape, some of the themes, some of the trends that we're seeing. We'll have a little bit of time for questions. Really interested to hear what everybody thinks and everybody's thoughts, and I know Jarrod's looking forward to that too. So feel free to fire those through on the chat as we go, and we can collate those and have them ready at the end. So with that said, as most of you will know, Jarrod is the chief economist at Kiwibank, born and raised in New Zealand, but he's actually spent most of his career overseas. He started his career as an economist at JP Morgan in Sydney, then moved into financial markets as an interest rate strategist for the Commonwealth Bank of Australia, before moving to Credit Suisse in Singapore as head of Australian and New Zealand fixed income and economic research. And then after 16 years abroad, Jarrod returned home in 2018, and he's been with Kiwibank ever since. So really pleased to have him with us today. And Jarrod, look, I'll hand over to you and let you do your thing.
All right, thank you. Thanks, Dave. And thank you all for joining the call today. I'm quite excited about doing a call like this. We generally get some really good questions, and I find the questions that we get at the end to be quite insightful. So please, as I'm presenting, if anything comes up that you want to question, please don't hesitate to fire some questions through, and we'll get to them at the end. Now, from my point of view, there are three things that I'd like to cover off on today. The first is supply chains and the disruptions that we've seen in global supply chains that have persisted for most of the year and will continue to persist into next year. But the good news around global supply chains is that what we're seeing is the delivery times starting to fall, but more importantly, the costs associated with freight are starting to fall as well, and starting to fall quite sharply. So there is light at the end of the tunnel. We do see supply chains freeing up into next year, and I think that'll be one problem that will resolve itself probably a little quicker than most people expect. The second point I'd like to make is one around a small open economy with a massive terms of trade shock, a massive income boost, and that's New Zealand. We have the highest terms of trade, so export prices relative to import prices, that we've ever seen in this country's history. So we're receiving more money for our exports and paying less for our imports, even with the issues around freight. So we've got a massive income boost coming into New Zealand, and that is setting us up for quite a decent growth outcome next year. And the third, I guess, final point is, with that in mind, we've got a very tight labour market, we've got very high inflation, and those are the two mandates of our central bank. And we have a central bank which is lifting interest rates, and will continue to lift interest rates next year. So we have a central bank lifting interest rates. We have a currency which I think is undervalued, and I think we'll see our currency lift next year as well. So for a small, medium-sized business, there are three things that you're wary about at the moment. There's supply chain issues, there's labour market tightness, but there's also the fact that the central bank is lifting interest rates and potentially going to help lift the Kiwi dollar. Now, to get into that, I'll share my screen. Can you see that? Looks like you can.
Yep.
Yep, all good, thank you. So looking at a first chart here, just thinking about supply chains around the world, we've seen the time it takes to deliver skyrocket in the last year. And we need to, I guess, unpack why that happened. First of all, there was a massive demand shock. We forget about the demand shock that actually started the supply chain issues. At the end of the lockdowns of last year, the world bounced back very quickly, and demand for goods bounced back very quickly, particularly e-commerce. Amazon had huge demand, and that came at a time where a lot of manufacturers, ports were shut down due to COVID, airlines were grounded, and they found themselves very short on supply or the capacity to deliver product. So massive surge in demand, and the supply chain froze. We've seen labour shortages due to COVID around the world. We've seen a shortage of containers, or containers in the wrong part of the world. And we've seen air freight basically decimated as airlines have had to be grounded. So when you take all of these issues together, we've had a massive surge in demand, but we haven't been able to supply the product globally, and which is why the time it's taken has blown out. And that's a problem leading into Christmas. But of course, it's not just the time that it takes to deliver a product, it's also the cost. And you can see on this chart here of the main shipping lines between China and the rest of the world, you've seen a 5 times increase in the cost of shipping. And to New Zealand, that's actually more like an 8 times increase in the cost of shipping. Again, to go through those reasons, a surge in e-commerce, what I call the Amazon effect. There's been slower turnaround times as ports comply with health regulation and social distancing. And there's been another problem with the industry over the last couple of decades, is that they have failed to actually boost their capacity, to boost the number of ships, the port's capacity to handle larger volumes. So we found ourselves with a surge in demand and inability to actually service that demand through supply chains globally. And what we're finding is companies are going from a just-in-time inventory management to a just-in-case inventory management, which means they're holding a lot more stock where they can, or they're ordering a lot more stock than before. But the good news in all of this is the Baltic Dry. Now, this is a global measure of shipping costs, and just in the last month alone, the Baltic Dry index has dropped dramatically. We've seen quite a sharp decline in the cost of shipping, particularly around Europe, and I think that'll feed around the globe in coming months. So we saw this very sharp run up in the cost of shipping, and we're now seeing quite a sharp fall in the cost of shipping that I think will filter down here in coming weeks and months. In fact, one of our customers at Kiwibank, he He hired a ship. It costs close to $3 million. He went back to hire another one. They said it's going to cost you 2.6. He went back to hire another one, and it's now costing 2. So the normal cost might be $1 million, but there's been a clear drop just in the last few months of shipping costs, and hopefully that continues into next year, which I think it will. Now, one thing that we've also noticed in talking to customers, and it's coming through in the NZIER quarterly business survey, is that there's a lack of stock of goods leading into Christmas. So our retailers have really struggled to get stock ahead of Christmas. One thing that they are trying to do to mitigate this problem is that rather than offer 10 products and try and get supply for all 10, they're narrowing down to their top 5 products and ordering a lot more of those products. So I think what we'll find coming to Christmas is that you'll walk into a JB Hi-Fi or you'll walk into a Harvey Norman, and you might find that rather than having 5 or 6 coffee makers available, they might only have 3 or 4, but at least they've got them in stock. And I think we'll see that throughout the retail industry leading into Christmas. But this is a worrying sign, this chart. This shows you that the supply chains really have disrupted retailing, and they have really struggled to get hold of stock into the busiest months of their year. Now, to continue with the theme of export prices and import prices, the terms of trade that I mentioned before, that chart on the left, is at a record level. It's at the highest level we have ever seen, and that goes back to 1861. So the terms of trade is basically a measure of our export prices divided by our import prices, and it's basically New Zealand's purchasing power. And we've never seen it this high. And what it means is there is a big net income boost coming into this country via our exporters. And the chart on the right just shows you how correlated the terms of trade is to our currency. The stronger our purchasing power, the stronger the income boost that we're getting via our exports, the stronger the Kiwi dollar tends to be. But at the end of that chart on the right, you'll notice that the terms of trade is well above where the currency is at the moment. The New Zealand dollar has been held down by a strong US dollar. What we expect to see is the Kiwi dollar to fall a little bit further near term, but then really bounce back quite strongly next year, based on strong terms of trade, but also interest rate differentials, which I'm happy to get into later on. So from your perspective, very strong terms of trade, income boost to our economy, shipping costs are getting cheaper, currency is going to go higher. So if you are an importer, then shipping costs getting cheaper, currency getting higher also helps you. Now, looking at the mighty Kiwi economy, this chart here is our GDP, our economy in a nutshell. And you can see there was quite a sharp contraction in economic output last year with the initial COVID lockdown. Now we're going to see another contraction. You're going to see a whole lot of headlines coming out saying New Zealand's back in recession. Well, those headlines, they'll only last a couple of weeks because we're not really going into a bad recession at all. What we've done is we've locked up Auckland, and that's going to cause a contraction in economic output over that third quarter. We'll get some information on that next week when it is released. But the bounce back is important. The bounce back that we get is going to be quite strong. And the reason why we're quite comfortable about the bounce back is that we've looked at our own numbers. So one of the cool things about working for the mighty Kiwibank is we've got some great granular data, particularly around credit cards and debit card spending, that gives us a real-time look into what's happening in the economy. And you can see the top chart there, total spending. Total spending has fallen during the lockdowns, but as we've slowly opened ourselves up, particularly as Auckland's gone into the traffic light system, you can see that total spending is back to where it was prior to the lockdown. So where is that coming from? The chart on the left, bottom left there, shows you that we are spending a lot more online. So e-commerce globally has taken off during the pandemic. Your Harvey Normans, your JB Hi-Fis, Rebel, all of these places are doing a lot more online than they ever have before, and they've adjusted. The other interesting trend or spending shift that we've seen is spending on building and renovations in New Zealand. So we get locked down, we want to convert a room into an office, or we want to do something outside. We want to get a pool, we want to get a pet, we want to make our homes better than what they were. And you can see we've spent a fortune on housing related spending. So contents and furnishings, we've seen quite a sharp bounce back in that. Home electronics, working from home, I think is the key here. A lot of people are spending more time working from home, and we're spending more time on our home, more money on our home because of it. Now, I also do a presentation like this to the Veterinarians and Pet Foods Association in New Zealand, and last year was the biggest year they had ever seen for the purchase of pets and pet related products, and we're still seeing some strong spending on pets. So we've become a lot more focused on the family home and a lot more focused on working from home. Now, the areas that are still heavily affected by COVID is obviously hospitality. Fast foods bounce right back, that's not a problem. But your bars, your cafes, your restaurants, I haven't updated this for the last few days, but we are seeing quite a significant lift in spending around bars and cafes now that Auckland's gone to the traffic light system. Now, when we survey businesses, there are two themes coming through from particularly small to medium businesses. They're wanting to hire and they're struggling to hire. So they're struggling to find the right people with the borders closed, and they're looking to invest. And they're looking to invest sometimes because they can't hire. So they're looking to automate or do things via machines than manpower. But this is a sign of an economy that's wanting to expand. This is a sign of an economy that's wanting to grow. You have businesses just a year ago who had thought that they would be contracting are now telling us that they're wanting to invest in both human resource and capital equipment. That's a very positive signal. Businesses don't come out saying we want to spend this money without confidence and in the future without a plan. And I think one of the main reasons why we're seeing these numbers spiking is because of the tightness of our labour market at the moment with the borders closed. It doesn't matter whether it's a skilled job or an unskilled job, it's very hard to find workers at the moment. At the mighty Kiwibank, I can tell you that we've had problems finding IT staff, and we've also had problems finding staff to fill our call centres. So it doesn't matter the type of the role, there is a shortage of good workers across the spectrum. And that is leading to wage inflation. So when there's a lack of supply and a strong demand for people, the price has got to move. And we're seeing wages starting to rise quite quickly. And that is potentially going to become self-fulfilling, because wages are rising, but so is inflation, particularly house price inflation. So we've seen house prices run up 30% in the last year, which is clearly unsustainable. But house prices have run up 30% in the last year. You've got households having to meet higher costs. You've got high inflation in general. So there is a real push for higher wages. And I think next year we're going to see wages really start to ratchet higher. Now, the rise in house prices has been driven by a shortage in houses around New Zealand. There's a chronic shortage of affordable dwellings in New Zealand. We've seen record low interest rates, and we've also changed our mindset when it comes to housing. We're spending a lot more time at home, working from home, and therefore we've put a much higher value on our home. And with all this activity, this hype, frenzied hype in the housing market, we've seen construction costs pick up as well. Construction costs have really taken off in New Zealand. Again, shortage of labour, expensive materials that they can't get hold of with global supply chain issues, and a surge in demand to build new homes in NZ. All of this, everything that I've just talked about is showing up in inflation. So inflation in New Zealand is running at 5%. Inflation in New Zealand will be running at 6% by the end of this quarter, and it'll probably peak a little over 6% in the first quarter of next year. With general prices rising 6%, wages growth at 2.5–3% just doesn't cut it. I think we're going to see a real push from employees to get decent pay rises with inflation running as high as it is. So again, this will feed back in to wage negotiations, I think, next year. Now, with that, you have a central bank that has a dual mandate. So on the one hand, they focus on inflation, and inflation is running well above their target of 2%. You know, it's running at 5% now and going higher. And they also focus on full employment. And with an unemployment rate of 3.4%, we're actually through what the government deems to be full employment of around 4%. So you've got full employment, you have inflation running above your target, as a central bank mandated to both of those things, and also asked to take a look at the housing market. There's only one thing that they can do in this world, and that is to raise interest rates. And what we're seeing is they've lifted the cash rate twice. They lifted it in August and November, and they're going to continue to lift the cash rate at every meeting until they get the cash rate from what was 0.25%, now 0.75% today, up to 2.5%. So just thinking through that lift in interest rates, what we are going to see is mortgage rates getting back to the levels seen around sort of 2013, 2014 type levels. So many of you will remember mortgage rates prior to 2008. You'll remember mortgage rates in the 90s, or some of you may even remember mortgage rates in the 80s. We're not going back to those sorts of levels, but what we will see are levels that are significantly higher than what they are today. We've seen the low in mortgage rates, we've seen the low in business lending rates, and the RBNZ is adamant that they want to shift the mortgage curve even higher than where it is today. And we've seen quite a significant increase in mortgage rates in the last couple of months already. We will see interest rates lift further from here. And given our interest rates are moving faster and higher than any other country around the world, our interest rate differential, so our interest rate versus an interest rate in, say, the US or Australia, for example, that difference is widening. That is also putting, or will put, upward pressure on our currency into next year. So for me, to summarize, the main message is, yes, global supply chains have been an issue, but they are freeing up, and we are seeing signs of both delivery times and costs coming down, which is good news. The New Zealand economy is doing very well. We've got great momentum. We've bounced back out of this lockdown, and we're seeing businesses wanting to invest. And I guess the last point is, with inflation running where it is, and with house prices running the way they are, and the labour market as tight as it is, the central bank is lifting interest rates. So all lending rates and all savings rates are going to rise from here. That's where I want to wrap up, and I'm really keen to get into your questions.
Jarrod, that's awesome. Yeah, look, thanks for that. We've got a question already coming through, but please encourage you to jot your questions into the chat, and we can put those to Jarrod. So first question, Jarrod, do you see any sort of sudden corrections or anything on the horizon that's likely to kind of cause a sudden correction, sort of suggesting here maybe house prices or the geopolitical landscape causing some sort of shock?
Yeah, there's always a risk. I mean, COVID itself is still a risk. You know, the Omicron variant and whatever variant comes next, there's always a risk around that, although I think we're managing COVID a lot better these days, and it may just be a matter of getting booster shots every year from now on. But yes, that's still an issue. Geopolitics, yeah, of course, you know, what happens with China and what happens with other countries around the world is always a risk. For us, house prices, you may have noticed that we've got house prices coming down reasonably quickly. Oh, that's inflation. There it is, house prices. So we believe that we've seen the peak in house price growth at the moment. There are a number of things weighing on the housing market at the moment. So LVR restrictions, there's the threat of debt to income ratios coming on as well. So again, that tightens up credit. And you've seen the tax deductibility being removed. Investors really have been targeted by the government here. So we think all of that will play on the housing market. But the good news in all of this is that what we are seeing right now is the supply of dwellings actually starting to catch up with demand, which is something we haven't seen in a while. I'm happy to talk through that if you like, but the main issue in New Zealand is that we've had a shortage of dwellings for decades, and now that the borders are closed, our population growth is quite low. There is a real boost in supply coming. There is a good chance that house prices correct in the next 2 to 5 years.
Yeah, interesting. Okay. Well, look, while we're waiting for people to sort of come through with some questions, I might just sort of start to move through a few minutes, just talking through the talent landscape at the moment. As you touched on, I mean, it's a tight labour market to say the least. Anybody that's tried recruiting over the last wee while has probably found that the amount of quality candidates that they're seeing is certainly short of abundant. So I just wanted to cover off a little bit kind of about the demand and supply dynamic that we're seeing right now. And I'll kind of move through this pretty quickly to make sure there's enough time at the end for questions. But no surprises. I mean, the current feature of the market is just an unprecedented number of jobs around. Look at the stats in Z jobs data. Vacancies have grown by close to 70% over the year to September 2021. I think in part that's kind of inflated by the drop we'd seen the previous year when things pretty much fell off a cliff due to COVID. I mean, pretty much I think about 2/3 of our work was put on hold at that point, but it's definitely bounced back. Job listings are now at all-time highs. And according to the stats from Seek, I think as of October this year, the manufacturing, transport and logistics industries, which I know many of you are kind of part of, 62% increase year on year on job listings. And that's far from the top. I think the insurance and superannuation sector was the highest with an 80% lift in job listings. So, I mean, huge competition out there. And as Jarrod's talked through, I mean, the obvious driver for that, just a super buoyant economy. But the other side of that coin is supply and just the availability of suitable candidates. Now, obviously, the sort of the key culprit to this is the restriction at the borders. Just looked at the migration numbers the other day, and through the year to September 2021, net migration was around 800 people. And if you contrast that with the previous year, so year to September 2020, 65,000 people. So, and that was hardly a normal year. I think the year to March 2020, which is a more normal period, was close up to 100,000 people. So dropped down from something approaching 100,000 down to 1,000. There's no prizes for guessing why we're finding it challenging to source candidates. And as Jarrod alluded to, particularly in the IT sector, where they're often kind of dependent upon people arriving into the country, it's been particularly compressed. I think beyond that, though, there's another few factors that are worth mentioning and sort of more subtle and less likely to hit the headlines. But up until lockdown, the flexibility for people to work from home, not everybody, of course, but a lot of sort of office staff, this change to kind of a hybrid working environment really soothed a lot of people to kind of scratch their itch. And we saw that as kind of the main reason why people were reluctant to start considering new roles. And then more recently, lockdown kind of added to that. So we found recently people just are struggling to have the mental bandwidth to engage in recruitment processes. Happy to have conversations, willing to talk through and listen to different positions, but with homeschooling and just being cooped up between sort of four walls for the last few months, challenging to get the headspace to start engaging in a recruitment process. So that's been one of the main things we've seen. I think also lockdown's kind of up until recently been a bit of an unknown quantity. So for a lot of people, the prospect of joining a new company and not being able to integrate, not being able to sort of meet people face to face and build those networks has put quite a few people off sort of venturing into the job market. The thinking has been better to stay and have the network and relationships you've got, which is understandable in some part, I think. And then the final thing, kind of at less senior levels, we're now seeing an increased appetite for people with sort of around 3 to 5 years experience to start heading offshore next year. They're seeing overseas markets sort of open up and starting to plan their OE, which again is kind of taking those people out of the market because they're just sitting tight in the current role. So all of that is widening the gap between higher demand at one end and the candidate supply at the other. And we're really starting to see and have been seeing for quite some months a super tight market. What that means, I guess the ultimate upshot is it's a war for talent. I mean, people are receiving a lot of approaches. They're conscious that their bargaining power is perhaps stronger than it's ever been. But at the same time, most people are not hugely motivated to move. But they can be enticed, and really the thing that's getting people over the line for the most part is money talks, and it's become sort of bigger salaries and rewards that are enticing people. The major exception to that has been where there's underlying factors in businesses that are kind of driving candidates to want to consider change anyway. So if there's sort of historic issues where they feel they're not being paid enough or not getting the recognition they deserve or not feeling connected to the culture, then that is sort of motivating them to sort of look for pastures new. But often people would put up with those things because if the culture and relationships with their colleagues has been good and they feel connected to the business, happy to sort of sit tight. And that's one of the big things that we've seen change recently. Companies that have had very strong cultures and that in some part have previously depended on that for retention are finding that the same level of loyalty isn't there because people are feeling disconnected from the business. That's starting to come through in engagement surveys where companies are seeing a reduction in loyalty, the focus on remuneration, the focus on benefits is up. And because a lot of people are having to operate remotely, just not seeing or not feeling the same connectivity in the same way. And so in lieu of that, people have sort of resorting to something a little bit more transactional, which is the compensation element. So just to touch on, I mean, what are companies doing about that? Well, at the moment, it's pretty much the remuneration question. So we're seeing a lot of multiple offers in the market and then counter offers. And so the solution that companies are trying to apply is through salary increases. In some cases, that's been across the board, although predominantly that's been in services businesses. So we're seeing with quite a lot of our legal clients, a raft of sort of early promotions, salary increases, and other businesses, a lot of counter offers. Some notice periods, sort of quid pro quo, where they might offer an increased sort of bump in compensation in exchange for a lengthened notice period. It's kind of jury's out on how sort of enduring that'll be as a retention strategy. But really the key lever has been remuneration to date. The big open question right now is how do you handle retention beyond just the lift in compensation? And from what we've seen, I think the most thoughtful approaches to that have been where companies are trying to reignite people's passion and inspiration and connection to the business. So sort of town hall meetings, trying to reiterate the vision, but then working with teams and working with individuals to help them to recognise how their contribution sort of ties into that. There's been quite a pronounced difference between what companies have thought the underlying issues were and what the underlying issues actually are. That kind of thinking was supported by a recent study by McKinsey you may have seen a couple of months ago. They surveyed people across the States, the UK and Australia. As a piece called the Great Resignation or Great Attraction. What they found was there was a major difference between what companies thought people were leaving for and the reason why they were actually leaving. So the three top reasons they thought people were leaving was higher pay and benefits, better work-life balance, and a greater physical and emotional health. And while those issues, they really did matter, the actual key points were people didn't feel valued by their organisation and they didn't feel valued by their managers. They were the two key drivers, or they didn't feel the same sense of belonging at work as they had done previously. So I think the key takeaway there is that there's seriously a transactional component to this that companies are trying to remedy through compensation, but actually most people are sort of feeling isolated. They're feeling like they need a sense of purpose, connection and recognition. So I think the takeaway again is companies should be examining the employee value proposition in all its facets. Try to look at the way people leaders are engaging with teams, address any fundamental gaps there, and just trying to be honest to rectify any exposure. And the final point just to make is perhaps the recruitment landscape has significantly shifted. We're still coming across employers that come from quite an old school position of we should expect a shortlist of 3, 4, 5 qualified candidates. Everybody should be champing at the bit to come and work for us. And we should have a sort of a traditional Q&A interview that's sort of skewed towards us evaluating the candidate. We've really seen that landscape shift. None of that really holds true anymore. So if you are in the market and you're trying to hire for a vacancy, I'd really encourage you, if you haven't already, to start shifting your thinking. In some domains, we're doing well if we can get 1 to 2 highly suitable people to the table. That's not the case across the board, but it's definitely the case in some areas. So the traditional shortlist is not always a practical reality. Second point is candidates have options, and as enticing as your vacancy might be, you really need to balance that interview dynamic. We'd never recommend anything other than a really robust selection process, but I think companies need to couple that with showcasing the opportunity, not presuming that candidates have already sort of fallen in love with the idea of working for you. And lastly, the market's still super hot. So if you don't act fast, somebody else is going to beat you to the punch. So they kind of be the three things that I think companies really need to think about in the hiring process. So that's a quick kind of quick fire view on the market. I've got a couple of questions here that we've still got a little bit of time to run through. So, Jarrod, I'll throw it back to you. Any predictions on the government relaxing immigration and what impact might that have overall?
Yeah, very good point. We are assuming that the borders open up next year and the government will relax the immigration policy. It'll be a bit of a double-edged sword, though, for a while. I think there's some pent-up demand, as Dave said before, for Kiwis to leave. So I think we might find, as we're opening up our borders, that we see more Kiwis leave than potentially Kiwis coming back or fresh migration for a while. So it could tighten things up further. But then I think towards the end of next year and into 2023, we are expecting net migration to go back to about 30,000. So I think you mentioned 800, going back to about 30,000, which is the long-term average. That'll help with the second question there, which is how do you see the labour market correcting? It is very much around the immigration policy. So I think things stay tight for a little while, and things potentially get a little worse as Kiwis leave. But then over time, we'll see a lot more migration coming back and helping to correct the labour market.
Yeah, it's an interesting one. I mean, we definitely saw a spike in migration just around March 2020 when a lot of Kiwis were coming home, and that's kind of slackened off for obvious reasons. Yeah. Our view is that the majority of people that wanted to come home have already come back. Everybody else is sort of sitting in offshore markets, and they've sort of endured the pain already. And there's very few people that sort of have the appetite right now to come back because of COVID. They're just kind of sitting it out. So maybe that'll change. We'll wait and see. So we've got one other question there before we wrap up. With shipping costs dropping back from 5x to long-term averages, won't this quickly bring inflation also back to within the RBNZ's target range? Yeah,
that's a very good question. It's why I jumped to this slide, which is hopefully still being shown. You can see in our forecast there, we do have inflation coming back for reasons that you just mentioned around supply chains fixing themselves. But when you actually look at what's driving New Zealand's overall inflation, you've got shipping costs on the one hand, but you've also got a lot of cost pressure coming domestically, particularly through housing and rents, household services. You've got transport, food, recreation. You look at that that bar chart on the right there. There's a lot of inflation coming through a lot of different areas of the economy. So yes, supply chains will definitely help with inflation falling, but we're worried that wages are picking up as well, and we'll see those housing related costs persist for a little longer. So I think it's just going to be a little bit harder for the RBNZ to reach their mandate, other than just waiting for shipping costs to fall back. But that's a great question. Yeah, one final question, because we always like to kind of wrap up on time, and you've been generous with your time, Joe, but we don't want to abuse that. But how far into next year do you predict supply chains to make a material improvement? When do you see things? You said things are starting to improve. When do you see things kind of getting back to more towards the norm? So things are improving now. We're hearing it on the front line. We're seeing it in some indicators like that Baltic Dry index that I told you about. I think a lot of the problems will persist over coming years. Like there's a shortage of ships, for example. There's a shortage of containers. These things take a while to build, but I think you'll see a dramatic improvement in a matter of months, not not years. So things will get a lot better over the next 6 months, but there'll still be some underlying issues that will persist for a couple of years, like the capacity of ships and ports and containers. That'll persist for a while, but we'll find ourselves in a much better place, I think, in the next 6 months.
That's good to know, and great to end on a positive message. Well, look, thanks, Jarrod. That's been fantastic. I mean, it's great to get a kind of a tour through what you're seeing, and I think hopefully everybody's found that pretty informative. I know I have. We'll wrap up there, just a little bit over time, but hopefully everybody's found that useful. So thanks for joining us, everybody, and we'll run these sessions reasonably often. So hopefully we'll expect to see something again in the new year. Jarrod, thanks for your time.
Thank you. Thank you for inviting me.
No worries. And everyone have a great run into Christmas, and hope everyone has a well-deserved break. Catch you later. Bye.
Cheers.